A very good afternoon. Welcome to HYCM's workshop with myself, Giles Coghlan, Chief Market Analyst. I do hope everybody is doing well. Looking forward to getting us ready for the session. Don't forget, as we get stuck into the session, any entries, exits, different instruments we talk about, the whole idea of this look ahead webinar is you're looking over my shoulder, seeing how someone from a professional trading background goes about making trading decisions, identifying high impact economic data events. It's not a signal trading service, so those of you who attend regularly know how that works. A very good morning, good afternoon to you. Very nice to see you here, Kingsley, Saeed, and just as other folks are coming in. It's an interesting week this week. So what I want us to do is to get straight into the session. So first of all, we do have a number of different earnings anticipated this week. There are some interesting tech names coming out, Salesforce, Zoom, and markets will be looking quite carefully to see how tech stocks are doing, and particularly what their third projected earnings are for the third quarter. So what markets will be looking for is any signs of further slowing down coming from US companies. And if there is a significant slowdown, particularly in tech stock projections, that could just weigh on stocks negatively. Just look out for that as we go through some of those big names like Zoom and Salesforce. They do have some impact, and markets will be looking at those. Now, in terms of the calendar, it's an important calendar to keep on track of this week. So we need to spend this webinar just looking at this calendar in order to see which tradable opportunities are most hotly anticipated. Now, today we've got quite a light calendar, and we've got some Fed speakers, Fed Jefferson speaking later on in the session. We've got some US durable goods orders. None of that is likely to be particularly market moving. It's quite a quiet session that we have. Coming in overnight, we have New Zealand business confidence. Now, remember the RBNZ kept to a more hawkish stance at their last interest rate meeting. And that was despite the cyclone Gabrielle that's been over there in New Zealand. The RBNZ want to keep hiking interest rates, and that allowed the New Zealand dollar to gain against the Aussie New Zealand dollar, and that was something that we saw quite carefully. The New Zealand dollar gaining on the RBNZ interest rate decision. I was looking to sort of potentially re-enter a short if I could back at that 1.100. Never got the pullback, and not looking interesting at trading this now. But if we see business confidence really gaining, wouldn't be surprising to see another drag down in the Aussie New Zealand dollar pair. What I've got on this screen is the Aussie 10-year and the New Zealand 10-year bond yield spread, which is that blue line. And what that bond yield spread does, it shows you the interest rate differentials essentially between the RBA and the RBNZ. And you can see that after the RBNZ, we had a big drop in the Aussie New Zealand bond yield spread, and that was an increase in New Zealand bond yields. And if you just take a look at the chart here, the New Zealand 10-year bond yield, you can see from last week we had that big surge in bond yields, which is, excuse me, which was what would be expected when a RBNZ takes a more hawkish tone. Don't forget to check out the HYCM blog to see that. So if business confidence really gains, then we could see another little shift lower in the Aussie New Zealand dollar pair, but I wouldn't look to trading it. And the best opportunity would come if business confidence suddenly really shows a decline, and if confidence is being lost, then you could see an Aussie New Zealand dollar just sort of bouncing from this 100 exponential, 200 exponential moving average. That's quite a nice little support area that price is in. And any reasons for Aussie strength against the New Zealand dollar would be good opportunities from a technical perspective. So if there's a big drop in business confidence, say it comes in, much worse than expected, -55, -60, you could see the Aussie New Zealand dollar pick up. particularly if the Aussie retail sales also showed a little bit of an uptick. It would only be a very short-term potential trading opportunity, but it's worth looking at. In terms of the French and Spanish inflation data coming up,
on Brexit time,
that is interesting. We have some inflation data out on Thursday. You can see coming up Eurozone inflation data. Now, the data, the components that make up this print are coming out throughout the week. So you've got the German data on Wednesday, and we've also got the French inflation data out on the Tuesday. So what we're looking for here is any kind of signs of a big miss in the data. So if we see a big drop in inflation, so if we start to see the inflation rate falling much lower than the market's expecting, say the harmonized rate comes in lower than 6.2%, then could see a bit of euro downside, and potentially euro pound short makes sense. The outlook for the UK has been pretty bad for quite some time, and kind of at peak bearishness for the pound. So a lot of the bad news has been priced in. So if we get any reasons for the euro to lose value, then a euro pound short would make sense. Particularly with the positive Brexit news gaining, that there's a potential new deal being sorted out in the UK between Northern Ireland and the UK that could make for a more harmonious relationship with the European Union and improve business activity conditions. That's broadly supportive for the pound. So if we've got a big miss in the French inflation data, we could see some euro pound downside. So that's one to watch for Tuesday. But remember, that's going to flow in to the main inflation data that's due out on Thursday. Canadian GDP data, what we'd need to see here for some CAD strength would be a very strong print, but this is fourth quarter. It's about to head into the second quarter of 2023 rather, I'm ahead of myself. So unlikely to have much of a market action. And we've got the preliminary data out month on month for January. So if that's very, very strong, you could see a little lift in the CAD, but that's not something I'm going to be chasing. US consumer confidence has been very high. It's expected to come in again high, 108.5 above the prior. Now, the best opportunity here would be if there's a big miss in the consumer confidence. It's one of the metrics that's been holding up. It's expected to hold up, but a big drop there would surprise markets, and that would be positive for risk. So it would be dollar negative, euro US dollar upside. You could also potentially see S&P 500 upside, but you'd need a big drop in consumer confidence, like 100 or lower. Unlikely to happen, but if it did happen, just need to be aware of that. Got some GDP data coming out for Australia. Again, it's the fourth quarter, and we are heading nearly in the second quarter for 2023, so quite historical. Good, strong growth here. Could be a potential reason just for buying the Aussie New Zealand dollar. That's worth considering. And look at the CPI indicator that's come in. This is a new indicator from Australia. Because they're wanting to keep on top of inflation, if we see that, pushing up above the prior 8.4%, that could be very supportive for the Aussie dollar, and that could give us an upside bias for the Aussie New Zealand dollar if inflation is seen to be more robust. Remember, inflation pressures will move the RBA to be more likely to hike interest rates. So anything above the prior 8.4% could lift the Aussie against the New Zealand dollar. Not expecting anything tradable, but look out for that. So what you'd look for is a beat in the GDP growth rate that comes in above 2.9%, and the quarter on quarter coming in above 0.9%. That's what you'd be looking for. And if you got that, that could be a really helpful Aussie New Zealand dollar upside kicker. Now, one aspect that I'm really interested in, the Chinese PMI prints. Now, remember, there's been a lot of talk about China bouncing back from COVID. This is the PMI data for February. Now, if you remember, a lot of that sort of pivot towards exiting or moving towards exiting strict COVID policies in China came around the turn of the year. And because China's a command authority, they didn't just come out and say we're exiting COVID zero policy. Because of a command economy and the sort of more left-leaning government, it's very hard for those kind of governments to ever admit U-turns or mistakes. So a change in policy can sometimes be perceived as a mistake, right? So a lot of these command or dictator kind of regimes don't just come out and say, okay, we're changing our policy now. They tend to pivot in more subtle ways. And that's what happened with China. Those of you who are following the HYCM blog, I was covering this in detail, particularly when they started prioritizing the vaccination of the elderly. That was equivalent to a pivot from China, because the elderly were the most vulnerable to spreading COVID, and they were making that a priority, which is a signal to me that they were starting to exit it. They have now started to signal much more formally an exit for COVID, as particularly their COVID zero policy. But what we want to see here is if we see a big tip up in PMIs, then there'll be a lot of confidence that come into the market from that, and that could really boost the Aussie. So if this comes in very strong, you know, above 52, above 55 for the PMI prints, and particularly manufacturing, if that comes in above 51.3, then look for that to boost the Aussie dollar, also to boost Chinese stocks. Also, I expect that to boost oil potentially as well, as expectations return for a more hawkish, more hawkish oil expectations. So watch out for that. The Bank of England speaking, Governor Bailey, not much expected from BOE's Bailey. This will be interesting. The ISM manufacturing PMI. Manufacturing has been going weak, and we've seen a divergence between services PMI prints out of US and manufacturing prints. So if this comes in weak, that's just what's expected. Okay, watch out for the prices paid component. The worst case scenario, if the prices paid component comes in hot, 48, and this comes in weak, 46.5, that's your stagflationary print. The best opportunity would, difficult, there isn't really an opportunity here, because if this comes in very strong, say it comes in above 50, then that just means the Fed's going to need to be more aggressive, so it'll be negative risk. If it comes in very weak, like 46.5, it's already expected to be weak anyway at 48, 47.4, and it's just another weak manufacturing print. So it's kind of important, but probably the best opportunity would be a little bit of dollar strength. If we saw this coming in above 49 and prices paid above 48, you could expect like US dollar downside. That would be reasonable for a scalping opportunity. Otherwise, if this comes in, prices paid drop below 44, and this comes in as expected, that could be taken as broadly positive for risk. So just watch out for that, but not necessarily a great tradable opportunity, but it's important to see the picture of what's going on. Thursday, we've got that Eurozone inflation data point, and we've got the German inflation data point early. So again, with the German print, if that comes in, below 8.5% for the year on year and below 0.6% for the month on month, I would expect euro pound downside. And then on Thursday, if this comes in much lower than expected, year on year below 8.1, and the core comes in below 5, then I expect euro pound downside. This would make the chances of a more aggressive ECB less likely if we start to see inflation falling. Okay, so that will be the big driver. So weak Eurozone inflation data, that should support the euro pound with the more positive sentiment that is surrounding the pound at the moment, with not so much money owed by the UK government from the debt that's being owed by the UK government in January. Took a surprise drop, and we also saw some more promising PMIs last week, and the expectations of a potential Brexit deal being arranged is just being underpinning, a little bit of pound support. Not that it's bullish for the pound, it's just been so bad for so long, just seeing a little bit of a snap back. BOE's pill speaking, watch out for that, and Fed's Walla. Tokyo CPI, that'll be interesting. Now, this is expected to fall quite markedly. Do you see how it's expected to fall from 4.3 to 3.3%? And the headline is expected to drop from 4.4 to 4%. So inflation pressure is expected to fall. That should weaken the yen. So that could be supportive of dollar yen upside. So watch out for that. A big miss here, and you should see the yen weaken. And if risk is positive, you might want to look at an Aussie yen upside, if particularly if markets are feeling more optimistic. The other aspect to look at on Friday is the second set of data out from China. Now, this is the private data. So this private data also has influence, and a strong print here will boost sentiment towards risk, and particularly towards Chinese stocks. So watch out for that. I'm expecting a bounce back from China. We did have a lot more activity around the Chinese Lunar New Year. Remember, cinema takings were up. The general sentiment was quite positive in China. More and more restrictions were being lifted, and more travel was taking place domestically within China. And those trends should continue. So I'm expecting February's PMI prints to be pretty positive. And you can see here that's already been reflected in the expectations, with 53.8 and 52.5 expected. So a lot of those, strong readings here is only what's expected. The Windows speaking later. Then we've got the services PMI print. Now this will be probably the most important print of the week, because recently what we've seen is a divergence between the manufacturing data and the services data out of the US. You see here, it's expected to fall to 54.5, but only down from 55.2, and quite expansionary above that 50. Whereas if you look at the manufacturing PMI, you see that that's expected to come in at 48, only up from 47.4. So manufacturing is firmly in contractionary territory below 50, but the services data out of the US is an expansionary territory, well above the 50. So we're seeing a difference in the way that the US economy is bouncing back. The boost, if you like, from services PMI prints is helping support the dollar, helping support expectations for a more aggressive Federal Reserve, and that's really what is boosting markets right now. So if we see a big miss here, and a big miss would be anything below 52.4, you'd expect S&P 500 upside, you'd expect Euro US dollar upside, Pound US dollar upside, also expect upside in gold and silver. So a big miss here would be the best tradable opportunity of the week, and it needs to come in at below 52.4. And also if we saw prices drop as well, 67 or lower, and if we start to see a big drop in employment, if that comes in contractionary territory, 49. So if you see a big miss for the headline, miss in employment, miss in prices, all of that would be positive for risk. So the simplest way to trade that would be S&P 500 long. That'd be the simplest way to trade that as a little short-term scalping opportunity. We then have a whole host of Fed speakers, Barkin, Bostich, Bowman coming out after the print. So it should be a good end to the week. Okay, folks, that's the main issues for us to be looking at. Any questions that folks have, please do type it in the box. But it's one of those sort of little itty bitty weeks. I'm personally looking at just taking short-term scalpable opportunities, looking for short-term moves. The inflation data, the services print, the US manufacturing, PMI and services print, and maybe keeping on the Chinese data as well. I'm sort of long, medium term structurally at the China 50. So I'm just expecting that to maybe lift that, and I'm also long, medium term oil. So I'm just maintaining those current positions and expecting them to be supported this week is what I'm expecting. Okay, folks. Okay, been a pleasure as always. I hope you have a very good week. Don't forget we were back here on Wednesday, and I will definitely be covering some important prints on Wednesday, but we will be looking in particular at one particular print and getting ready for that, and that will be the services PMI. So this Friday, services PMI print that we've got coming, I will get us ready for that on Wednesday, and we'll look into an instrument we could look at currency pair, and I'll go through how I'm looking to trade that for Friday's print. It's the most exciting print of the day. Okay, folks, take care and have a very, very good week. Thank you, everyone. Goodbye.